All right, thank you for coming out tonight. Welcome to Commercial Real Estate Mastering 4. I'm one of your hosts, Rob and Dexter, with David Carter, Rose DeMcConnell, Nick DeLeon, and our special guest speaker tonight, Susan Bryant. Going to be talking to you about how to save money on your taxes. You know what kinds of awesome real estate you have for your taxes. So we'll turn it over to her. She'll get started on her presentation, roughly 20 minutes, and then you do a small Q&A afterward. You might say a couple things, and then we'll just spend our rest of the night. Make sure you get subscribed for a little later, for people just want to talk and network. So thanks for coming out. And if you don't know us, we don't know you. So please come up and introduce yourself at the end of the night or before the end of the night. Thank you.
Okay, awesome.
Susan, everyone.
Right. Woo! Okay, so there's a guy on LinkedIn and he calls himself the Fun CPA. And I said, oh, he stole my title. I really, did I turn it off? I thought that is definitely what I should be named. So we are going to go through a presentation. But stop me if you have questions. Like, this is not meant to be me talking to you. It's meant for us to have a conversation. So if there's something you're like, I don't understand that, or I have a question, stop me. Or if you're like, hey lady, you need to move on, then also let me know. We'll move the conversation along. All right. All right. So I'm playing a little bit on our theme tonight because we are in the toilet room. Okay. I'm sorry. Oh, you can? Okay. Do you need me to talk into the microphone a little closer? Is that better? Okay. Okay, awesome. So taxes are probably your #1 expense. If you own a business, if you own real estate, it's one of the things that you have to spend a lot of time working on. And this is not a one-time process. This is an iterative process, constantly going back and looking for ways for you to whittle away your tax liability. Seems like such a weird word to use when we're talking about taxes, to whittle away, but truly, you'll almost never find one silver bullet that's going to change your tax situation. It's the cumulative effect. It's an aggregation of a bunch of different strategies all working together. So we're gonna spend some time on that tonight. Maybe get this to work. Okay. Okay, a little bit about my firm. So we are Unboxed Advisors. So we really focus on 3 different things at my firm, and that is that we want to optimize the amount of money you make. We want to help you save money on taxes because that means you've got more money to spend in your business where you're actually going to get some kind of ROI. Unfortunately, when you send money to the IRS, like, you don't even get a thank you note. They do nothing. And the third thing is we actually have to protect the wealth that you build. So risk mitigation becomes a really big part of your holistic planning, the more and more wealth that you accumulate. So this is it's more than what a CPA would normally do. So it's not just, here's your tax return, we're done. It's, how do we help you to understand how to leverage your assets to make more money and then protect those in the long run? Made it clicker. This is my team. We're a very small firm. We're more of a boutique, if you will. We work with a very certain select type of client who is interested in really understanding the holistic picture of how we get from point A to point B, and formulating a team around them in order to progress along that trajectory. So my business partner, Catherine, and Brittany, who put this presentation together. It's a lot harder than it looks. Okay, things that my lawyer is going to make me tell you is like, this is really, every situation that we come across is specific to you. Like, tax planning is not meant to be generic. So for those of you who've gone to Google University and you're like, I don't understand how this applies to me. Yeah, you can learn a lot of stuff by Googling it, but the specific advice you get from a professional, there's literally no replacement for that. So make sure to take care to get advice for your specific situation. Okay, so we're gonna start by just talking about record keeping in general. So this is probably the #1 area that I see most people go wrong, is that they neglect this overall thought about compliance. They think, I'll get to that. Yeah, I formed that new entity. We'll get around to that. We'll get that set up. We'll get the QuickBooks configured. And it becomes an afterthought. I mean, as we all know, you guys are entrepreneurs, whether it's real estate or anything else, it's shiny object, shiny object, shiny object. That's just how you're wired. So you have to really build in this discipline by working with somebody who helps you to make sure that compliance is key. It is just too expensive to do things the wrong way, or to do things a way and then realize, oh, that's the wrong way, and then have to undo it and redo it. It can be really costly, especially on taxes, penalties, and things like that. So take some time there. Record keeping is your lifeline. Keep your books, hire somebody, or better yet, automate. Okay, accounting, you guys, like the AI, it's freaking amazing. Most of this work can be done by a computer instead of a person. It's a person supervising a computer now. So if you're still entering something manually, stop and think, what program can do this for me? Because guaranteed, it can be automated in some way. Data-driven decisions versus the gut, right? So many people like look at their bank account, oh, I think I can afford that. That's gonna be okay. You have to stop that. You have to start looking at financial reports, using them, understanding them, and making sure that going forward, the information that you're receiving is both disciplined, like you are receiving data on a routine basis and being informed about what's happening in your business. And a lot of times we talk about smaller enterprises and they think, oh, I'm too little for that. You build the discipline now, because when you get bigger, if you don't have that discipline, it will be even more difficult to get it. I mean, maybe that's like an atomic habits thing or something. You know what I mean? You gotta build it now while you're small. Of course, maximizing tax deductions. We'll get more into that later. And then prepare for future transactions. Like begin with the end in mind, the Stephen Covey thing, right? You have to make sure that you understand everything that you need to be doing in your entity right now to be planning for the future. So contemplate and work with a qualified professional that will help you to not only think about what's happening today, but what's going to happen tomorrow. What is your long-term financial plan look like, and what are you doing right now to get there? Like, this is sort of like when you open up your Apple Maps, the first thing it asks you is, where do you want to go? If you don't know that financially, how do you create a roadmap to get there? You don't. You're pretty much just on the hamster wheel going nowhere. Okay, so you gotta protect your assets is what you gotta do. So anytime you've got a business, you gotta make sure to get your personal stuff out of there. I can't tell you the number of times I see people who are continuing to pay personal expenses out of their business accounts. It's crazy to me. For everybody who's got an LLC, like everybody raise your hand if you have an LLC. Right, it's everybody. How many corporate veils have been pierced because there's personal activity running through that business, and the first thing an opposing counsel is going to do is what? That LLC is a sham. We're going to pierce through that corporate veil, and now you personally are liable, right? How scary is that? That all now your personal assets are totally at risk. So do not operate your business as your personal piggy bank. Even if you're tempted to do it because you think, oh, that's going to reduce my tax liability, you're really just opening yourself up to a bunch more risk than you need to. For those of you who are in some type of especially residential portfolios, you really make sure you're keeping this stuff by property. We have in my lifetime as an accountant, probably the messiest thing from a perspective to undo is someone who's got all of their activity for multiple properties running through one bank account. And it's like, I don't know what spectrum bill that is. Is that this property or this property, this property or this property? You have to know that that's how the tax reporting is going to work, is by property. So keep it segregated from the beginning. Do a really good job of that. Or better yet, I don't know if you guys have ever heard of a program called Divvy. Has anybody heard of Divvy before? Divvy is really awesome. You can set up a whole corporate card, and you can say, I'm going to use this virtual card for this property, this virtual card for this property, and then it all syncs into your accounting software by property. Like, you don't even have to think about it. I mean, it's an amazing tool. And then really kind of thinking about the ROI on property management. A lot of times what I see is that people have a lot of residential and commercial properties, but they never set up their own property management company to try to capture their activities, their personal services. And then creates an avenue for them to create a whole nother set of ways to capture expenses and really even build their own retirement in a lot of cases. So it could be extremely powerful. And if you are not familiar with the Corporate Transparency Act, has anybody heard of that yet? No, brand new. Okay. So this is a new law that goes into effect January 1st, 2024. And it will require you, if you have a business that has less than $5 million in revenue and less than 20 employees, to create a beneficial ownership information form and file it with an organization called FinCEN. FinCEN is a government agency, and you're going to have to do that sometime next year. If you create a new business, you have to do it within 90 days. Yes. It's a federal requirement. Every LLC you own. You heard it here first, okay? Now, big question, and this is something that even us as professionals are sorting out, like, who's going to be responsible for that? Is that your attorney? Is that your accountant? Like, who's going to do it? But who's ultimately responsible? The owner. That's right. So be aware. This is like, so like weather aware, except for like law aware right here. This is the big one. The government's really trying to crack down on like basically money laundering. So they want to know who's going to own the companies. Like, is it a cartel who owns the entity? I'm pretty sure the cartel will find a way to not report that they own the entity. But, you know, hey, that's okay. Okay. I'm trying to move this along. So sorry. Okay, so a few things that I know that people don't think about a lot of times is understanding exactly how to select the right legal entity for what it is that they're doing, or know how to move between legal entities. So make sure that you are working with a proactive tax advisor. If you're forming a new entity with a business, this is not just a conversation between you and your attorney. It's a conversation between you, attorney, and accountant. If you have an accountant who's MIA, get a new accountant. This is like knowing when to file for divorce. The relationship is not working. That's pretty much what you have to be thinking about. It is really, really key, especially this time of year, that you are working with someone who is helping you to project out your tax liability for this year. That you should know what that number is before you get to 12/31. And if you don't know what that number is by the time you get to 4/15, or it's like, you know, 4/12 and you're getting a phone call like, hey, you owe $50,000, that's a really bad accountant. You're working with the wrong type of person. You have to work with somebody who's helping you to make decisions and influence what's going to be reported on those returns and informing you well in advance of what those tax liabilities look like. There are a lot of things that you can do to influence your tax situation, but most of those expire at 12/31. Just can't do anything about it once the year passes. I mean, your options become severely limited. So make sure that you understand all of those opportunities and that you're not letting one of them pass you by, or if they are passing you by, like you're doing it with the knowledge that it's gone. This is probably the area where I see people trying to DIY it, like the same people who are not like, they don't cut their own grass, they don't change their own oil in their car, but they're like, I'm gonna prepare my own tax return. What? Doesn't even make any sense. So work with someone who's gonna help you understand what your tax liability is, minimize it, and then let the professionals handle it. Another area where I really feel like people don't even look at their stuff is insurance. They do not take the time to go through with a broker and understand exactly what those policies are comprised of. And I would say anything from personal homeowners, car insurance, all the way up through business and other properties beyond that. People think that they know what they've got covered, but they've got it on autopilot and things change. So make sure that you've got that covered, and also make sure you've got an umbrella policy if you have any type of significant wealth outside of your assets or like our LLCs, that are insured, because you could potentially have personal liability and you need to have that covered too. So I think that's a duplicate there. Of course, one of the biggest things in real estate is, can I deduct that loss, right? That's probably the #1 question that comes up, and it's complicated. Your situation may be different than everyone else's, and it may be different by property based on the activities that you're performing in that property. Also, what other activities do you have going on? Do you have a full-time job, part-time job? Is this your full-time job? Are you a real estate pro? Are you materially participating? Or are you actually participating? I mean, if you went to that publication and you read it, you would realize, like, this is a really, really complicated decision-making process. So if you're wondering, like, I wonder if this is something that I could qualify for, that's a really best time for you to have a conversation with your accounting and tax advisor to make sure that you are taking advantage of things. And then I would say this too, on top of that, is document it contemporaneously, right? That's the #1 way that you can defend your tax position, is documentation. Did I document it at that particular moment? I just saw an article from the Wall Street Journal that if you are a high income earner, and the IRS came out with this news release, like, I don't know, a couple weeks ago, Wall Street Journal just stopped publishing it. If your income's over $1 million, watch out, because the IRS is coming for you. I mean, that's basically what they're saying. They're like, and they're going to start with the people who owe tax money. So if you have tax debt, they're first going to go after them. But once they whittle that away, then they're going to start coming anybody who's got high income, so over $1 million. So if you're not taking the time to dot your I's and cross your T's, make sure you've got everything documented, every tax position, down to like accountable plan on taking your home office deduction. Now's the time. We have to get prepared. The IRS has made it very clear they're back in business, and they're going to start creating more audits, and enforcement's going to go way up. So get ready for that. Okay, a few things to think about. Has anybody done a cost segregation study on like a residential property at all? Have you guys done it? KBKG, did you use that tool? If you have not used that tool, check it out. It is awesome. I think it's like $400 or $500 to do a cost seg on a residential property. It's super cheap. So if any of you are building a residential portfolio, I would definitely go that direction for sure. Has anybody ever thought of or set up a captive insurance company before? Are you guys familiar with what that is? All right. Yeah. Okay, so there is a tax provision that allows for you to set up an insurance company. And the cool thing about owning your own private insurance company is that when your profitable business has risk, then it can pay a premium to your private insurance company and receive a deduction for that. So if you can imagine, I've got a super profitable, let's say, construction company, right? And it's got $2 million worth of net income. And I say, yeah, but there's tons of risk. I mean, we're working in the oil field business. We've got, supply chain issues. I've got concentration for my customers, whatever. I can pay that $2 million to my insurance company, get a deduction, and eliminate my tax liability in my business. When the money comes over to my private insurance company, it's under the exemption limit, which is a little over $2.2 million, and I don't have to pay tax on it over there. So you can imagine that's pretty cool. The interesting thing about a captive is that it can not only insure a business, but you can also now sell insurance. So start thinking about in your multifamily properties where you're like, everybody's got to have rental insurance, right? Renter's insurance. Well, now you can sell it through your captive. And because you're taking care of the property, right? And you can make sure that there's potentially no claims due to maybe, I don't know, water damage or whatever, right? So you have a lot more control over it, and it's a way to make extra money. Same way go for commercial properties. You can insure all sorts of risks. Bless you. So if you're not familiar with them, they can be a really amazing, not only business tool, but also a huge tax planning tool. I like them. They're a little bit more on the aggressive side, but I don't know an entrepreneur who doesn't like to take a little bit of risk. So qualified opportunity zones. A lot of times people will sell properties. They don't want to do a 1031 for whatever reason. What most people don't know is they think, oh, I've got to buy into one of those stupid funds that's a qualified opportunity zone with my financial advisor. That's not true. You can actually set up your own qualified opportunity zone. So you have to work with an attorney to create that, but that can be super powerful. And it not only applies to real estate, but also to businesses in an opportunity zone as well. So make sure you look at that. 1031 exchanges, there are ways, and I don't know if you guys have heard about this, but where you can do a 1031 exchange, and instead of buying another property, you could buy into it's like a mutual fund, but it's eligible to receive those monies. Because sometimes you just can't find another deal that makes a lot of sense economically. So you want to park that money somewhere, and that can be a place where you can do it. So you don't have to go through the hoops or jump through the hoops or worry about like, what am I going to do with this gain? You can just park it in that 1031 fund. So that can be really cool. And then 179D and 45L. So 179D and 45L really pertain to improvements that are made to a building where it comes to energy efficiency. Of course, everyone's really interested in making things more, is it ESG? Is that the word to use these days? So obviously that's really popular to try to, the government wants to encourage people to spend money in order to create, I guess I should say buildings that are more energy efficient. And so they're really encouraging that. So the 179D is a deduction that you can get, but the 45L tax credit is actually kind of fascinating because it not only applies to the owners of buildings, but it also applies to the designers of buildings, architects, engineers, contractors who are working on those spaces too. And that can be a very powerful tax credit, not only for for-profit businesses, but also for not-for-profit businesses. So, one thing that I'm sure you guys are aware of, but is always an important reminder is depreciation recapture. Many times, we see business owners, real estate investors who, they do a cost seg and then they're surprised when they sell it and they have to suffer through that depreciation recapture. So just make sure that that's part of what's going into the planning discussion when it comes to taxes. Okay, and I think it's really hard for me to do this. Oh, one other really quick thing to talk about. How many of you have a will in this room? Okay, so the rest of you need to get busy and you need to do that. Otherwise, really, it can create a big mess, especially if you have any type of assets. Like, if you die without a will, your estate has to go through probate, and that's public record. So just imagine the people in your family, like, I don't know, just think people like we've all seen like superstars, celebrities who go through, they die without a will, and then it's all public record, and then their heirs are basically victims. They're preyed upon by other people because they know exactly how much money they just inherited. Like you can prevent that from happening. Not to mention, like, you don't want people arguing over stuff. So get that fixed for sure. FLPs, if you have a potentially highly appreciating asset and you are in a position where you're in a taxable estate. So right now, if you're a single person, that's a little over $13 million, soon to be cut in half in about 3 years. Your estate would be subject to taxation. 40%, y'all, that's a lot of money, fair market value of that. So FLPs are a great way to get assets out of your estate by gifting them to your heirs at a discounted rate. So if you're not familiar with that as an estate planning technique and you have significant wealth, it's a really important thing. Another area that I see people totally mess up on is they set up an LLC. It's a manager managed. I'm the manager and something happens to me, and guess what? Nobody else could do anything in that business. So payroll stops, bank activity has to cease, like everything has to stop. So make sure that you are setting up an alternate manager in your LLCs so that in the event something happens to you, your spouse or business, I don't know, somebody can at least conclude the affairs of that entity. Life insurance can be a very powerful tool. Make sure you have disability insurance. And then I mentioned that the estate tax rules are going to change. And then questions. Those are really questions. Yes, sir.
So you guys do trust like
So typically when we start talking about trust, estate and trust planning, it's really important to involve an attorney because all of the documents that are created when a trust is formed govern that trust. And so it's really more of a legal arrangement than it is, there are certain tax benefits for certain kinds of trusts. So it's just a matter of working through that with the estate planning attorney. But that's a conversation that has to happen, for sure.
Your firm so you have some network where any foundation have trust take care of all that in one thing, or is it like
yeah, so that's a really great question. And that's usually the piece that hangs up a lot of entrepreneurs is that it's so many people and so many relationships to have to manage. Like, I don't know who to go to for that. Like, or they just get a name, like, go talk to this estate planning attorney, go do that. And it sits in their inbox for, I don't know, a couple of years. And then it happens all the time. The path of least resistance is inaction. So most people do nothing, which is why most problems get worse and they don't get solved on their own. So the way we do it is that, yes, we've got a network of people, just depending on the type of business, depending on the size, personality. There's a lot of different things that can go into selecting the right team to put around an entrepreneur. And then we actually attend all of the meetings. Like, we'll go to the insurance meeting where we talk about insurance and the estate planning conversation. We'll meet with a banker, the attorney. Like, we go through that process because we feel like it's our responsibility to quarterback those initiatives to make sure they get done. Because if they don't, ultimately it's going to hit the bottom line somewhere. It has to get done. So, yeah, my pleasure. Okay, any other questions? Oh, yes. Great question. So I take on clients that first have a mindset that they want to grow. That's a really important part of it. The other thing is I'm really, I work with people who are looking for a holistic advisory solution. So like I don't work people who, like, here's a tax return, just do my tax return. We call that a tax one night stand, is what we call that in the business. We don't take those. So really looking for that holistic advisory, because at the end of the day, we want to make sure that you are whole and complete as a individual who owns businesses versus someone who just needs a set of tasks completed. So that's who we work with. Typically, they are business owners of some kind, whether that's real estate or an operating entity or some combination thereof. Usually, if you're inclined to do one, you're inclined to do another. Outside of that, it's really just kind of based on their desire to kind of seek that type of advice. Not everyone is ready for working with someone who kind of wants to help them solve all of those problems all at the same time. Typically the people that we work with, they usually start around 500K and up in income. But sometimes it just depends. Sometimes people have a lot of opportunity to save on taxes, and naturally their income will go down because of the taxes we can save them. So it fluctuates, but we'll take a look at it case by case for sure. Thank you for that question. Awesome. Well, thanks guys for letting me come today. I really appreciate it. And if you have any other questions, just hit me up. I'll be here for a while. Thanks. Thank you.
All right, so thanks for coming out tonight, and thank you for that fantastic presentation.
Thank you.
Very helpful information. And I would encourage anyone who wants to save money, who needs a new accountant, I need help to reach out to you, because I have been through accountant after accountant after accountant. I do stock market trading, so options trading, day trading. I own multiple family, I own single family. I still have a W-2, and I have been through 3 accountants who said they knew what they were doing. And yeah, so this is the kind of person you want to connect with. Thank goodness I connected with you this year, and next year for part of my accountant this year. Hope he's doing it.
Right. Yes. Oh, the tax deadline is Monday. Like
Right.
tax.
So thank you once again, and let's go ahead and get to what we're here for, and that's that week. So thanks again for coming out.
Yeah, I hope that was okay.
Good, yeah.
Okay, good.
That's good. It was helpful. I was taking notes, things I didn't know. Good, you're dropping knowledge bomb. Good job.
Okay, well, it was nice to meet you. Did I answer all your questions about the excessive loss rules and stuff?
I think so. It was like, I think there was one about like a specific investment. Is there like a max on that particular investment for that year?
No, it's for the entire year.
Okay,
Yeah,
so like I have a $1 million write-off, one investment, I invested $1 million.
yeah, and you're gonna be maxed at that 578 or whatever it is.
Yeah, you
Yeah,
get max for that.
that's
Then
right.
The next amount you can roll.
Then you can roll over, and then
into,
it's
like,
subject to the 8,
trillion or whatever.
right, and then it's subject to the 80% of
Right.
your taxable income. That's
Got
the
it.
only part, is that, I mean, to take advantage of the excessive loss rules and the NOL roll for, I mean, you'd have to have a lot of money, you'd have to have a lot of
Yeah,
income.
okay. What about, my friend had this question. He's invested in the ATM fund
Okay,
and he gets cost equity there. And someone in his family is a real estate professional. So he thought there might be some sort of issue because it's equipment versus real estate.
I
I
mean,
think it's cost seg, right?
cost seg on equipment? I mean, bonus depreciation maybe.
Yeah.
Like, I can see that, but bonus depreciation would totally put you in a loss.
Yeah.
As long as you got basis to take the loss, you're good.
Right.
So,
If it's
no,
ATM fund or real estate.
I don't know. As long as you have basis, at-risk rules would apply. right? I mean, that might be the only place I can think of if it's a fund where you might get hung up.
Okay.
So, yeah, okay, all right, awesome. Okay, awesome.
I think they were here first.
Okay, okay. Hi, Susan Bryant, nice to meet you. Susan Bryant, nice to meet you. Yeah,
So we're both in the commercial real estate on the brokerage side.
okay,
So I work with a lot of investors. I have someone who does need a CPA. She did a 1031 exchange. recently.
Yeah.
And the old CPA is on, I guess it's proactive.
yeah,
So